Hello and welcome to the Moss Adams Private Foundation virtual conference. We're pleased that you're able to join us. We have two presentations this afternoon, totaling 2 CPE credits for this portion of today's conference. For the National Association of State Boards of Accountancy, to qualify for these credits, you must attend each session for a minimum of 50 minutes and respond to 3 of the 4 polling questions in each session. And before we get started with our afternoon session, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to hand it over to Wendy to get us started. Wendy?
Thank you, Amy. Good afternoon, and thank you for joining us for our afternoon sessions of our Private Foundation Conference. If you joined us this morning, welcome back. If you're just now joining, welcome to our second annual Private Foundation Conference. With the interest of time, we're going to go ahead and move right into our next session that's on today's agenda, current legislative and guidance updates in the world of philanthropy. We have some wonderful presenters lined up for this session. So I will now hand it over to Lauren Haverlock, Moss Adams tax partner, to get us going. Lauren?
Hello, everyone. So as you can see from the session name today, we're going to be working a little bit to pull back the curtains on what's happening from a legislative and guidance perspective over in Washington, D.C., and looking a little bit more at the current events and potential future objectives that our federal government has and as it pertains to exempt organizations and a little more broadly to start. I think I was just on a call with one of our speakers, and they said we're currently in a time of disruption and uncertainty, and that completely applies to our sector. It completely applies to philanthropy, and so it's something that it's good to get a handle on where we are today. So we do have 2 incredible speakers who are going to help us navigate this update. I think probably a lot of you know there is kind of an exempt org speaker circuit, and they are often on the exempt org speaker circuit, and honestly 2 of the best out there. So this is kind of like the Taylor Swift and Beyonce of the speaker circuit here. So it's going to be a good show, probably not 3 hours, but it could be if we wanted it to. So first, I'd like to introduce Meghan Biss, who's a member with the law firm Caplin Drysdale. She joined Caplin Drysdale in their exempt org practice group in January 2018 after more than a decade with the IRS, where her last position was as a senior technical advisor to the director of the exempt organizations division. So, and then excitingly, she was recently recognized as one of the best lawyers in America, which I support and completely agree with. Not second, but also of equal best in terms of lawyers here in America. Alexander Reid is the national team leader at BakerHostetler and the national team lead of their tax-exempt and charitable giving team. So Alex chairs the American Bar Association Tax-Exempt Organization Committee and previously served as the legislative counsel to the Joint Committee of Taxation. And so with that introduction, I'll let our Taylor and Beyonce take it away.
Thank you very much.
Wow,
Taylor
Alex, you're
and
now going to
Beyonce,
have to shake off that great introduction. Just shake it off.
Shake it off. I love it. I love a pun. Fantastic. So welcome everyone. We are here joining you from Washington, D.C., where the government is heading straight into the dumpster fire of a shutdown. I'm told by our government relations people that there is a 100% chance of a shutdown. Absolutely, it will happen, which, predicting what Congress is going to do is a perilous sport in any times. So saying with 100% certainty, that really says something. So the big question, of course, is how long will it last? It could be a short one or a long one. I've seen Goldman Sachs some years ago estimated that every week of a government shutdown shaves 0.2 off of GDP, but then that amount gets picked back up after the shutdown. So there's sort of, there's a lot of loss, certainly a lot of chaos, a lot of vacations to Washington, D.C. and national parks that will be ruined. But the economic carnage hopefully will be minimized. Meghan, as our IRS veteran, can you tell us the interesting news about the IRS in the shutdown? Did we lose you?
Meghan got muted, so
Meghan got muted. Well, I'll tell you the news, and then Meghan can explain the ramifications of the news. So the news is somehow, through craftiness, the IRS has funded itself, or is funded through the Inflation Reduction Act, and all of its employees will be kept on and working through the shutdown. Meghan, are you back?
Yep, I'm back. Sorry, I don't know what happened. I was clicking unmute and it wouldn't unmute. So
right.
User error on my part, clearly not Beyonce or Taylor level technology skills. No, so you're right, Alex. IRS is fully funded, which means while other agencies may be shut down, the IRS will not. Their employees will continue working and engaging in operations as usual, which means returns will still be getting processed, applications will still be getting processed. If you have private letter rulings or other things going on, audits, you name it, going on with the IRS, those will still continue because they have their budget already approved. Now, to the extent that there's interaction with other agencies that the IRS engages in, those might be delayed. One good example is if you need an old copy of your application for tax-exempt status. Organizations are supposed to have as part of their records a public disclosure copy of their application. If you needed that, if you didn't have it on hand and you say, gosh, I'm going to request that from the IRS there coordinates with the Federal Records Center for storage of those applications. And if Federal Records Center is closed, then you won't be able to get that even if the IRS employees are there to see that you submitted that request. So that may be the one hiccup, is that to the extent the IRS has interactions with other agencies outside of the Department of Treasury, there will be some closures.
What about controversy stuff, appeals, tax court?
Yeah, so IRS appeals still open. DOJ, I don't think they were included in the previous funding. So we would want to double check those appropriations from last time around to see if DOJ has funding that'll extend out. But if you had a case pending in tax or in district court or court of federal claims, the Department of Justice attorneys who would litigate that might not be at work, even if the courts themselves are still open because they might be funded. Same
so
thing
that means
for tax
you just
court.
win, right?
No, that would probably just be sort of pushed out the date for the government to respond. There's normally an emergency process that goes in place. So when there is a shutdown, and I can say this because I lived through a government shutdown at the IRS, there is sort of an emergency plan that goes into place where certain critical level agency officials are there to ensure that some low level of operations still occur. Like if there were court filings that were due, et cetera, there are certain exceptions where a government employee can do what they need to do, even though technically you cannot do work while you are not getting compensated. So.
Yeah. Well, so this will be really interesting, and I sure hope it doesn't go on for months, because there's really little to be gained from it.
But everybody loses in a shutdown. To be honest, yeah. Government service, essential government services for many individuals do not occur. Employees are at home. They don't want to be at home. They want to be working. They want to be doing their jobs, and they can't. And taxpayers can't get the services that they need. It's a lose-lose. Yeah. So turning to what looks like a homily on the screen, it's like a poem. I enjoy how this came out formatting-wise. It's sort of an argument that I've been working on and thinking about. There's this question: what should be done about donor-advised funds? Is the question of the day, as it has been for a long time, and it's of interest to private foundations as well. And this is an attempt to answer it, and it's really by way of explanation that all charities have something controversial about them, because all charities have a mission, and you're required by law to have a mission. 501c3 says you must do something to make the world a better place, change the world in some regard. Foundations, I think, are more effective at it than other organizations, or they can be. They perhaps used to be more effective at it because they don't have to continually fundraise and experience the moderation of their opinions based on their need for donations and financial support. They can really go out on a limb because they've got their funding secured. And they were punished for this in the 60s. The last great tumultuous time, which I think we're entering a new one now, but the last great tumultuous time with the civil rights era and the free speech movement and the Red Scare and the threat of nuclear annihilation and all of that, many of which still continues to this day. But it was very, it really bothered a lot of policymakers in the 60s, and they responded by muzzling private foundations. Donor-advised funds are in large part a workaround around the 69 Act, around those rules that limit private foundations. And their increasing popularity, I believe, is due to two things. One, the wealth effects of the retiring generation having $80 trillion to give away or spend or whatever they're going to do with it, but also the fact that donor-advised funds have fewer limitations and therefore are more attractive. So, to answer the question, what should be done about donor-advised funds, my suggestion is let's think about loosening up the restrictions on private foundations so that they are more appealing and attractive and able to gather some of this $80 trillion that's going to be moving from one generation to the next. So that's my homily to begin today's presentation. Anything to add there, Meghan? No, I mean, I think that, it is important as we think about sort of a spectrum of giving. I think a lot of times now with clients, we don't see that they're only choosing to exercise giving through one specific vehicle. We're seeing a lot more private foundations that also utilize a DAF for some of their giving, especially if they're going to have a lot of giving to very small organizations that they want to be able to support year after year, because they're looking at radically changing who their grantees are and how they effectuate change in line with their mission. So I look at it more now as a spectrum of giving, or a continuum of organizations, rather than you need one private foundation. No, we can have lots of different entities, each one able to accomplish whatever your given mission is.
And let's not forget
flowers bloom. Yeah.
Let's not forget the 501c4 organizations too, and that's something that we'll talk about a little bit more about tomorrow. But I just wanted to share the agenda really quick for today's session and then launch into our first polling question, which is what people will need to answer in order to get their CPE today. Amy, do you want to take that away?
All right, thank you, Lauren. So the first polling question for this session is, what part of today's agenda are you most interested in? And your options are A, trends in congressional oversight of tax-exempt entities, B, new legislation and how it impacts my organization, C, the latest on donor advised funds, D, IRS updates, or E, all of the above. And then to respond, you're going to select your response on the slide and then make sure you hit the submit button. And if you would like to receive CPE credit for this particular session, you will need to respond to at least 3 of the 4 polling questions.
Great, thank you.
And it looks like most have responded. Let's leave it up a few more seconds. Everyone can get their response in. All right, here you go.
All right. All of the above is the overwhelming winner.
A little something for everyone.
Yes, very good. Okay. All right. So, in congressional leadership, you know, the big news for this Congress has been the flip of the House to Republican control. The echoes of the first act of the Congress to select the Speaker continue to reverberate to this day, as Kevin McCarthy, to win election, needed to make a large number of concessions to let's call it the MAGA wing of the Republican Party, to support his bid for Speaker. And part of that includes the appointment of Jason Smith to chair the House Committee on Ways and Means. Jason Smith is from Missouri and represents the 6th poorest district in the United States, which is very interesting. Quite unusual for a Ways and Means chair to represent a district that doesn't have, you know, a lot of corporate interests and international interests. Apparently, he's very attuned to his constituents' interests and supports things like the child tax credit, which are not exactly high on the mainstream Republican to-do list. They're not even on the blue dog Democrat to-do list, because that's what Joe Manchin was opposed to in a lot of the fight in the Inflation Reduction Act was about the child tax credit. But here we have Jason Smith supporting policy like that helps the neediest because they live in his district. So it's interesting. It's quite different. We'll see that meted out a little bit more in the investigation that he initiated and that people have been responding to about political activity in C3s and C4s. Over on the Senate, it's a little more business as usual, with Chuck Schumer continuing as the majority leader and Ron Wyden continuing to chair the Finance Committee. Ways and Means and Finance are the two committees with jurisdiction over tax, and so we typically look to them to take their temperature to see, you know, if legislation is going to move. You know, obviously Wyden and Smith are pretty far apart from each other politically, and so you know, it's unlikely that we'll see a lot of legislation moving and joint action between those two groups. But you know, stranger things have happened. It's funny when you get to the far enough extremes in both parties, you start to see similarities that they might not see themselves, but if they actually decided to join forces on a more populist agenda, you actually could see a lot of legislation happen. I don't predict it because I think the politics of doing that aren't favorable, but it's a different House and a different Congress that we're seeing this time around.
But both of them are still very interested, and we'll get to this in the upcoming slides, on investigations. Some you'll see on the Senate Finance side are much more focused on high net worth individuals and places where they think that there are potential tax loopholes that high net worth individuals are utilizing in order to, in the Finance Committee's mind, skirt around their tax responsibilities. On the House Ways and Means side, meanwhile, you'll see that there's an effort that's going on currently with C3s and C4 organizations, especially those engaged in sort of voter registration, get out the vote, and other type of nonpartisan electoral activities where there's some insinuations that perhaps they are not quite as nonpartisan as they claim to be.
That's right. And, another way of saying that is that both committees are deeply focused on high net worth individuals skirting the law. It's just that they're focused on different high net worth individuals.
Different groups, but it is still an active time right now with Congress. Even though there isn't necessarily legislation coming out of it, the committees both are engaging in a robust set of activities.
That's right.
And looking at organization.
When they can't enact legislation, they focus on oversight and hearings. So there's an ongoing interest in investments in relating to China. We haven't seen the results of that investigation, but apparently certain universities do a lot of joint development of intellectual property and projects either in healthcare or engineering in China, and there's some concern that our tech might be transferring to China to the detriment of our national security interests. So that's coming out of Representative Murphy's office. The oversight committee laid out this plan in February that just clearly mentions tax-exempt organizations and particularly hospitals and political oriented organizations as being on the target list for oversight. And we're already starting to see some of that come out. And then the last one on this slide is this interesting set of letters to McKinsey and Company about their work for Providence Hospital. So you've got a service provider, McKinsey, a for-profit consulting firm, giving advice to a nonprofit hospital system. The advice has to do with debt collection practices and how to improve profitability. And the Finance Committee is telling McKinsey that they are doing bad. They're doing badly by giving this advice. So I haven't, it's hard to tell what the results of these inquiries are. They're not always public, but I think we'll be hearing more as the committee makes its investigation results known and what they've found. We've got the name, image, and likeness in collegiate sports. I don't know if Meghan, should we talk about that issue just generally now, or hold it for the slide later?
I think sort of big picture now, but then a note to put a pin in it, because we will come back to more specific IRS guidance dealing with 501c3 organizations that are engaged in name, image, and likeness as their activity.
So big picture, what we're looking at is NCAA, the College Athletics Association, does not allow universities to pay their students to play ball. And And so entities controlled by universities also cannot, provide economic benefits to players to attract them to schools. But what if, in the community, there's a foundation and it just gathers together some money, and that money happens to be used to pay some of these people who happen to play for this local school, and maybe there's some appearances that the students get paid for to appear at, the local car dealership or whatever. Maybe they're even teaching the students about how to do these kinds of appearances and how to be a generous pro athlete. When does that cross the line? That's the issue of interest.
And the balance here on that name, image, and likeness, the sort of balance that the NCAA reached here was, okay, we understand that these athletes, in many instances, although they're playing here at a college level and are, obviously most, if you're engaged in certain sports, right, football, basketball, etc., might be really generating a lot of revenue into the university. But not all of them are going to go on to play professionally. Their careers and their windows may be limited. They may not have the opportunity to play professionally and really have a substantial revenue stream there. And that tension of how do you ensure that these young athletes are receiving some form of compensation for what they're doing, and how they're assisting the school and capitalizing off of their name and image without running afoul of those NCAA rules.
Yeah, there's kind of a schizophrenic feeling here, where on the one hand, we don't want, college athletes getting paid. We don't want economic benefits flowing to them because we want them to be students. But on the other hand, if their names, image, and likeness are going to be exploited by somebody for tremendous economic benefit, we feel like the students should get some of that. So it's complicated. Congress is interested, IRS is interested, and I don't think we have a consensus on what the right view should be about student athletes. Moving on to the tax-exempt hospitals and the community benefit standards. So this was one of the two issues that Jason Smith from the Ways and Means Committee is interested in. Congressman Schweikert really handled this hearing. And I would say the upshot of it is a sense that nonprofit hospitals receive a lot of economic benefits, and they aren't doing enough to earn it. That was the message I got from watching the hearing, is that was the sense of the members of Congress, that nonprofit hospitals get a lot from the government and don't give enough, and that they should maybe do more, especially around charity care and relief of poverty. My response to that always is, I think relief of poverty is great. We should have more of it. It should probably be handled through a completely separate program, like insurance, because that's what insurance is for. I don't really see that being the responsibility of the hospital to provide insurance. I don't see poverty relief as being an obligation of a hospital. I think hospitals should focus on curing disease, pretty much exclusively, and that our other social policies, should be addressed through appropriate government programs. So I feel like it's unfair to blame hospitals for problems not of their own creation, and ask them to do something that's both impossible within their budgets and something that the government's been reluctant to do, namely provide health care for everyone. So that's my take on it. I don't know. What do you guys think?
I think that Congress has spent a lot of time trying to come in and sort of piecemeal with its oversight of large exempt organizations that clearly have a lot of revenue and they're concerned about their activities, whether it be hospitals, colleges and universities, et cetera. And so they keep trying these singular fixes, whether it be, implementation of 501R, with those new restrictions on hospitals, 4960 with the tax on excess compensation, various mechanisms, the tax on colleges and universities with substantial size endowments, et cetera, where Congress is trying to piecemeal solve what it thinks the problems are, rather than saying maybe we need to go back to the drawing board.
Fair enough.
I guess if it's hospitals, maybe it's not donor advised funds, but it seems like there's always something that the IRS is looking at, whether it's credit unions, hospitals, whatever it might be. So, yeah.
Yep. And I think, sort of interest that we hear right now going on from a lot of our clients, whether they be 501c3 or 501c4 organizations or private foundations who are making grants to organizations engaged in these activities, is this August 14th request for information by the House Committee on Ways and Means, looking at political activities of 501c4s, activities of 501c3s, and asserting that there is a sort of foreign influence coming in for elections, and maybe rethinking the need of donor disclosure. As you all may recall, the IRS had updated its regulations, permitting 501c4 organizations to no longer have to disclose their donors to the IRS. Instead, they can keep that information there should they ever get audited. It could be requested on an audit, but they don't need to affirmatively complete Schedule B and provide that information. And there seems to be maybe an idea that at least the letter asks for people's thoughts on whether the IRS needs to issue more guidance, and whether donor disclosure should be required.
So of course that's the most ironic thing ever. Maybe not ever, but it is ironic. We'll just leave it there, that Congress says to the IRS in its annual appropriations rider that the IRS cannot spend $1 writing a rule to clarify how much unrelated activity a C4 can do, including political activity. So not $1 can be spent on the reg project that the IRS spent years of effort trying to do. And we in the private bar have spent years advising the IRS about how to do it and providing input there. Congress said, nope, you can't. This reg project shall stop. No appropriation if you continue it. And then
and that's been in place since 2015.
Since 2015, and then turning around and saying, gosh, why don't you guys provide more guidance? It's really too much.
And I'll say that the committee has in that letter attached in appendices of various examples that they've gleaned from public news sources. Of course, being the majority side of the committee, I think they're being a little selective in which examples they are choosing to use in their appendices. But pulling out public news stories regarding certain organizations, and the people who have funded those organizations. So it'll be interesting to see where that goes. Lots of organizations right now are in the process of providing responses to the House Ways and Means Committee. I saw one published today in the EO Tax Journal from CREW, and I've seen numerous other ones that other entities have submitted over. So we'll see if this will lead to additional investigations, hearings, or further requests for information.
Yeah, it's kind of interesting that that 501c4s must accomplish a social welfare purpose, and they can use lobbying to accomplish a social welfare purpose. But all political activity is considered unrelated to a social welfare purpose. Even if your political activity helps you accomplish your objective, it's considered unrelated. But you can just do a lot of it. We just don't know how much.
Well, and I think
so
part of it too isn't just that political activity anymore. It's the question of funding activities that people previously and historically have thought of as okay, like getting out the vote, like
Right.
voter registration for historically disenfranchised groups of people, like election integrity and ensuring that poll workers are protected and have, the ability to engage in their job without fear of reprisal. Those types of, democratic activities, I think, are being drawn into question as people look more closely at what organizations are doing and the how and why.
Precisely the issue, may I bring us back to the homily at the beginning, precisely the issue that gave rise to the 69 Act, voter registration. That's what the Ford Foundation funded in Cleveland after the race riots in '68. And that's what inspired the segregationists in Arkansas, Wilbur Mills, and others to enact the 69 Act.
So now that we've covered hearings and what's going on currently, why don't we do a quick tour, Alex, of legislation that's been passed.
Yeah.
I don't know that this is going to be incredibly pertinent to everyone, but I think we could do a quick overview of it.
Yeah. Okay, so hot. Like, this is, the economy has completely changed as a result of this bill. The Inflation Reduction Act has dumped billions and billions and billions into the economy for clean energy. It allows nonprofits to participate through direct pay. There, even in the statute, it looks like nonprofits would be able to buy a credit from a producer of clean energy, and then buy that credit at a discount and then sell it to the IRS and get a refund. The regulations that came out recently put the kibosh on that beautiful plan, but I'm still not convinced that Congress didn't allow it. So I don't know, maybe at some point we'll see a window where nonprofits can just straight up buy tax credits from for-profits, sell them, and generate free money. Wouldn't you guys love that? But if you are in the business,
UBI? Would you
would that be UBI? I don't think so. I think that credit, a refund for a credit is not considered taxable under
and
general principles.
I do want to highlight one of the things with the Inflation Reduction Act and some of these credits is that a lot of foundations are funding these types of activities as well. So they're funding charitable organizations becoming more energy efficient or having energy efficient projects. And there are ways that you can structure that funding so that the recipients are able to receive the benefit of the direct pay as well as your funding, and that funding doesn't impact them. So the IRA really is important for foundations to get a handle on if you're funding those types of activities.
Absolutely. Yeah, I'm told that the number of workers in the U.S. green energy market has gone from 450,000 to 1.2 million in the course of a year.
Yeah, and I think the one other thing here too is as organizations look at and see the guidance that the IRS is putting out, right? When Congress passes a law, IRS and Treasury have to sort of drop all of the other things that they're doing, turn their attention to trying to quickly put out notices, revenue rulings, proposed regulations, etc., implementing that statute. But that's a long process. So they'll put out regs and they'll get comments back onto them. And the people at the Department of Treasury who are well versed in the world of exempt organizations and these credits are also very interested in what nonprofits are experiencing as they're attempting to navigate these rules. Are they able to make these contributions over? Are there other issues that might exist as a result of these rules? And so would encourage organizations that are in this space, as you're looking at it, if you see issues, please let Treasury and the IRS know. They'll take responses via letter, but Treasury people, Amber McKenzie in particular, are always really happy to meet with any organization that approaches them to say, we have comments on the rules that you all are proposing.
Great. This one is this issue of whether the new corporate AMT, which is the tax on book income, applies to the book income of nonprofits, including passive income. So normally when we look at unrelated business taxable income, that excludes passive income, investment type income. But book income doesn't really have a concept of unrelated taxable income. The whole point of book income is that it's not taxable income. It's a different definition. And so there's a little bit of a glitch in the statute where Congress said we're going to exclude UBTI, unrelated business taxable income, from a book tax, which is not a tax on taxable income. So there's a statutory glitch. We think that Treasury has got it under control, but we're watching it.
Yep. And then, Alex, do you think we could maybe skip the Secure Act and just briefly hit on the items that I think organizations are interested in knowing, gosh, are these ever going to come back? This $300 charitable deduction for non-itemizers. Do we think that's going to ever come back? Do we think Congress can have agreement there?
Well, honestly, what I think is going to happen is the shutdown is going to go through October and a good chunk of November, and then Congress will come back and pass a bunch of funding and possibly some tax extenders and then go home for Christmas. And so it's going to be a sloppy, a big sloppy mess when they do it. And so it's not out of the question that that extenders will be re-upped without a scalpel, but more of a just kind of like, let's redo it because it's too hard to renegotiate things. So I think it's possible.
Yeah, and I think both that and the idea of that increased limit for individuals on the charitable deduction are one that many donors that we work with are interested in. Obviously, it doesn't drive all of their donation decisions, but gosh, it sure is helpful. All right, future legislation. So, Alex, do you want to explain for everybody real quick what the Green Book is?
Yeah. So the Green Book is the non-binding legislative wish list of the executive branch. So the Treasury Department puts a couple of items out there and says, "Hey, Congress, if you were to throw this in and pass it, we would not object. In fact, it might encourage. We might even want to sign the legislation more."
So there are currently two Green Book proposals that I think are really important for private foundations to pay attention to. Obviously, it doesn't mean that they're going to pass, right? The administration is sort of given its wish list to Congress that it would like to see. But two items that deal with private foundations and how they utilize donor advised funds, or how they compensate certain individuals who work with them. And that first one is a restriction on private foundations being able to use DAFs to satisfy their 5% payout.
Yeah, and on this one, I think that it's important to understand that donor advisors do not own or control the assets in the donor advised fund. And this proposal does treat the donor advisor as though they were the owner. So if a private foundation makes a grant to a donor advised fund, for example, in a liquidation, or in order to meet their annual 5% distribution requirement, they put some money in a donor advised fund, and that private foundation continues to exercise advisory privileges with respect to the donor advised fund, this would say that they no longer meet that payout requirement.
And then the other proposal, is payments from to disqualified persons, counting towards that 5% payout.
And whether your family members are actually providing, family members of the disqualified person, of the founder, board members, are they providing real services, or is it just kind of money that is not appropriately going towards charitable purposes when you pay them. So
importantly, though, it doesn't change the personal services exception. So if that proposal did go through as is, it wouldn't automatically result in compensation to those family members being a self-dealing transaction. Instead, it would just say that that compensation that you're paying for that percentage of activities doesn't count towards your payout. So on the bright side, many of the foundations we work with are well over their 5% threshold. So I don't think they're quite as worried about this, but knowing that it's not going to all of a sudden result in self-dealing, I think is really key.
Yeah, agreed.
And then why don't we get to the next polling question?
All right, thank you. So the second polling question for this session is, which best describes your feelings about the proposed ACE Act? And then your options range from it's terrible, I hope it goes away completely, all the way down to I'm not worried. You can read over those and select your response and make sure to hit submit. We are going to try and move through these pretty quickly since we're running short on time.
The answer may be, I don't know what the ACE Act is.
Accelerating charitable efforts. It's the proposal to impose a payout requirement on donor-advised funds and to restrict certain types of community foundations and national donor-advised funds to a particular period of time, 20 years.
All right, here are the results.
I would agree. I don't think Congress can agree on this either. It's been sitting around and pending for a couple of years now. I don't know that there's going to be any motion here on it. But as Alex noted, introduced in the not yet introduced in the current Congress, was introduced in the last Congress, and established different types of requirements on donor-advised funds to have them pay out things a little bit more quickly.
Yeah. I think the key issue that there's misunderstanding about is that a lot of people believe mistakenly that a donation, that if you make a charitable contribution today and you take a deduction, but the money, the charity receiving that gift does not spend it on charitable goods and services until 5 years from now, that there's some sort of disconnect between the amount of tax benefit the donor got and the amount of public benefit arising from that gift, that there's some kind of a raw deal going on because of that delay in time. But an economist will tell you that is not true, because the gift is invested and grows. And so even if it's given 5 years later, the amount used to produce charitable goods and services is greater than it was at the time of the gift. So the math works out. So there's no arbitrage there. I think that's a pretty key misunderstanding.
Mm-hmm. And then the proposal for the Nonprofit Seat Act is to rescind and replace the Form 1023-EZ. There has been a lot of, I think, consternation since the IRS instituted that form in 2014 or 2015 for smaller organizations, right? In order to use the Form 1023-EZ to apply for exemption, you have to be able to attest that not only are you going to have revenue under $50,000, but also you're not engaged in certain types of activities. Schools, churches, hospitals, donor-advised funds, supporting organizations, etc., are all not allowed to use the 1023-EZ, regardless of what they think their revenue is going to be. And so there is a fairly narrow class, and the IRS does have an audit program where 3% of those who get approval on the 1023-EZ are supposed to be examined. Now, whether or not those are actually occurring and the IRS has the resources to engage in those audits is another question. But in theory, there is supposed to be some form of oversight where it may make sense that for smaller organizations, there is a less cumbersome process in place for them to obtain exemption.
And I think that question on IRS oversight is the perfect segue.
Lead us into what is the IRS doing?
Yeah, we'll have Amy start out with another polling question.
All right, so the third question, did your organization claim the employee retention credit? Yes, no, not yet, but maybe soon. And while you're responding, we have been, we have been getting quite a few questions on how you obtain your CPE certificates. So just know that we're going to be sending those out within the next 2 to 3 weeks. So keep an eye out for that email.
This poll is going. Do we want to talk about some of the recent updates from the past, I guess, couple days from the IRS relating to the employee retention credit?
The IRS has had enough. They say that there's a lot of fraud going on in the employee retention credit. You know, there's a lot of ads on the airwaves about you know, trying to help people who aren't eligible to claim it anyway. So there's a pause on employee retention credit processing.
Well, and I think the employee retention credit and other COVID-related relief were implemented rather quickly and meant to provide, you know, much needed lifeline to organizations who really needed funding in order to continue to stay open and operating during the height of the pandemic in those, you know, 2020, 2021 years. That being said, when you implement a program quickly that's meant to try and get money out the door fast, that means that there are organizations and individuals who will take advantage of the situation and unfortunately not use the funds for the intended purposes. So it is a little ripe for abuse.
Yeah. Once there's a robocall involving a tax planning structure, its days are numbered.
I feel like for our nonprofits, they're uniquely impacted because there's so much public information about the organization and who sits on the board, and these groups are reaching out to board members and anyone who's listed on a 990 to tell them that they qualify for this. So we feel, you know, we've done analysis internally for organizations and they still get these calls. And so you've got a board member or a CEO or someone who says, why haven't we done this? We're leaving money on the table. And that can be intense internally in an organization. So just stay strong and make sure to document your position internally and don't be sold by the credit people.
Good advice.
Absolutely. And then, you know, IRS announced earlier this month that they plan on increasing their efforts on audits and oversight of high net worth individuals. They've been telling us for a while that this is coming. When Commissioner Danny Werfel was appointed, he made clear that this was a priority, that individuals with income over 400,000, I think his promise was people with income under 400,000 wouldn't see an increase in their audit rates, but those with income over 400,000 would. But I think also important here that the IRS has been working a little bit more collaboratively internally to have programs where it's cross-functional. So they may have an audit on a high net worth individual, and that is then going to touch the other entities that individual is participating in, whether it be a partnership and they're pulling in partnership audits at the IRS, or it's their private foundations and other charitable organizations and they're collaborating with EO. So we're seeing now teams at the IRS starting to form where they're going to work across functions to engage in these audits. And it might be a flavor of what is to come with the fact that the IRS has been permitted by Congress to restructure its operations and no longer be segregated into business units that are specific to individual taxpayer types, these tax-exempt government entities, large businesses, partnerships, small businesses, etc.
Yeah, I heard they're even using artificial intelligence to do it now, so watch out.
Well, they've relied too on data analytics for a really long time. They have a number of offices that help pool together these statistics and help generate this type of information. I think when you have an agency that hasn't had resources for a while, they've had to be a little bit smarter in deciding how to make selections.
I know, and I heard that the last go around with the data analytics didn't really yield great results because it's just hard. The data is hard to read.
Well, and the data is based off of what's reported on the 990 or the 990 PF. And as I'm sure many people know, the 990 PF has not been updated in a really long time. So it's hard to identify that checking a particular box is in and of itself indicative of non-compliance. Other thing from the IRS. So Office of Chief Counsel is in charge of this priority guidance plan. This is their roadmap of guidance items, whether it be regulations, revenue rulings, et cetera, that they want to put out, that this is what they want to cover. But of course, legislation like the Inflation Reduction Act takes priority, and these items get pushed further down on the list. So you'll see that some of them have been on here for a very long time. For example, this guidance on group exemptions and whether or not the IRS can reinstitute its group exemption ruling process has been pending since 2020 when the IRS asked for comments. Regulations on supporting organizations have been pending since 2016 when proposed regulations were published. So many of the items that are on this list, and we've given you the list so you can just have it for completeness purposes, but many of these items are not new. They have been things that have been here sort of year in and year out for the last several years. In fact, I think 7611 actually wins the prize here. Those regulations have been pending since 2009, and those deal with who can sign off on an audit of a church.
No one can.
No, there is someone who can. It is the TEGE commissioner, and that is how the IRS is engaging in church audits. And that was permitted by a district court case called Bible Study Time that determined that the TEGE commissioner is a sufficiently high-level official. So a little strange that they wouldn't finalize the regulations when they have a court case.
Now.
Right. And then, Alex, were there other things that you wanted to note on the PGP?
No, I'm disappointed that they never take our suggestions, but I get it that they have a lot on their plate. There's just a lot happening in the world, and we could use some advice. Anyway.
All right. And then the other thing that they did was issue this GLAM, the General Legal Advice Memorandum, on June 9th, 2023, on these NIL collectives that have come in and gotten their own 501c3 status. I think GLAM is sort of a fun name for IRS guidance. It certainly makes it sound more glamorous than it really is.
Absolutely. It goes with the Taylor Swift and Beyonce thing. It's strange to have all this guidance that it's not binding, and yet it's supposed to have a big impact on the risk assessment that taxpayers have of whether to do a transaction or not. Meghan's
particularly when it can
a panel on that for the ABA in October. Yeah.
I would say particularly when this results in a statement, a very broad statement, that it is the IRS's opinion that many of these organizations do not qualify as 501c3 organizations, even though many of them have been given exemption by the IRS determinations office itself, that they don't qualify because they are operating for a substantial non-exempt purpose, which is serving the private and benefit interests of the student athletes. I think we'll have to wait and see what happens with examinations and whether or not there's litigation.
So the message is it's our opinion that they're exempt, but now we've changed our mind and it's our opinion that they are now exempt, except this is just a GLAM, so don't hold me to that opinion.
I have a case pending in tax court right now where the IRS is arguing that examinations did not get to weigh in on determinations, and therefore determinations opinion does not matter.
Oh, wow. I hope you win
That's
that
a little
one.
bit terrifying.
That happens sometimes.
Yes.
And on that note, we have our final polling question with Amy.
All right, thank you. The last polling question for this session is, have you received any notices, communications, or correspondence from the IRS in the past few tax periods? Yes, we responded and everything was cleared up. Yes, it seems like we are in constant communication with the IRS. No, but we think we may be hearing from them soon, or no, and we are ready if we do.
Nice.
We've been seeing a lot of communications, especially for organizations that have tax payments, and the IRS reallocates overpayments and doesn't really explain why. So that's kind of the most common communication that we're seeing outside of, exams. It's those just kind of housekeeping items from them.
Yeah.
I think we've seen a lot of those. We've also seen a lot of problems with the new e-filing system where there's been some hiccups as organizations have tried to e-file their returns, and now all of a sudden they're getting late filing penalties when it's really the IRS's fault that there was the hiccups in getting the returns submitted to begin with.
And with that,
so we're at the end. Did you want to bring us home?
I'll send it over to Amy to do that work. But we appreciate you all and our speakers as well. So thank you all.
Yes, thank you all for a great presentation. I really do wish we had more time for this topic. I know we had to rush through some of the slides, but to our audience, you can download them from the handouts window and then review them at a later time. We're going to take a 5-minute break and then regroup for our final session. So please keep your webcast console open and join us back here in 5 minutes. Thank you.
All right, everyone. We're going to go ahead and get started again. I hope everyone has enjoyed our sessions today. We're going to go into our final session of the day. It's an Ask the Experts panel. I just wanted to give a little bit of insight into the approach. When you registered for the conference, you had the ability to ask a question that you'd like to be addressed during the conference. So we do have a number of those that were already submitted, again, at registration. In addition, we'll try to get to some of the questions that we've gotten so far today that we haven't been able to answer in the chat or that we didn't answer as part of our presentations. And then if any time allows, if you submit additional questions, we'll try to get to those as well. But we've only got an hour, and just know that we will address as best as we can all questions that are not, that we're able to answer after the conference as well. I will go ahead and just quickly indicate who we have with us. For the most part, all of these panelists, except for Liz Dollar, were with us earlier today in earlier sessions. So if you've been with us all day, you will be familiar with them, but I'll just give you a quick overview. We've got Brett Addis, a director in our consulting group. Myself, I lead our foundations practice. I'll be moderating. Liz Dollar, she's a partner and leads our not-for-profit practice for the firm. Lauren Haverlock is a tax partner. Ariel Lybarger is a senior manager in our consulting group. And Alexander Reid from BakerHostetler. All right, with that, let's go ahead and get started. And I'm going to really focus first on those questions that were submitted at registration. I want to give those folks that took the time to submit those questions, I want to make sure that we address those as part of the panel today. So we did have a question regarding expenditure responsibility. And Lauren and Alex, I think this will be in your wheelhouse. What is considered a full and complete report on how funds were spent for an expenditure responsibility grant to a private operating foundation? I'm sorry. And I think this is one of the specific requirements with expenditure responsibility, that full and complete report. So I believe the question is really what constitutes a full and complete report when it's given to a private operating foundation?
Well, Lauren, would you like to begin, or shall I?
I had started to, but I didn't unmute myself. So faux pas number one for the day, but
I'm sure
I can
you
start.
said something riveting.
It was really
Lauren.
good. It was really good. It's not going to sound as good the second time around, but I was going to say that one of the things that we find that there can be some footfalls is there's really two types of reports, and this is all from the IRS perspective, right? For every organization, there could be spins on what that full and complete report looks like in terms of your assessment as to whether that is an impactful grant. But in terms of IRS compliance with the full and complete report, one of the things that we find that's a footfall is that annual reports as well as final reports need to be obtained. So if you've got a expenditure responsibility grant that goes and is being used over multiple years, there might be multiple types of reports that you get, both annually and finally. But when it comes to IRS perspective, that annual report has one set of rules and guidance that as to what it needs to include, which would be information about the use of the grant funds and compliance with the terms of the grant, how you're meeting that compliance, and then progress as you're going through that process. But with that final reporting, there should be some more detail, and indication as to like what was the ultimate final, kind of result of the grant that was received. Now that's kind of a simple situation, and it can get a little bit more complex when you've got endowment grants and when you have program related investments. But I just wanted to pause there to see if Alexander has any high level comments about expenditure responsibility.
Yeah, I would say that there's sort of the carrots and sticks, for lack of a better word. There's sort of the good things that you want to show in your report, and then the fact that the bad things didn't happen. So the good things that you want to show is effectively how the grant is charitable and meets your charitable purposes. So there's activities that directly accomplish a charitable purpose, and then there's activities that contribute importantly to the accomplishment of a charitable purpose. So those are two, sort of concentric circles of breadth. And once you get beyond that, if the activity that you're funding does not clearly have a substantial relationship to the accomplishment of a charitable purpose, then it may be less charitable. Then you switch over into the negative side of things that are prohibited that you want to avoid. And so you want to avoid spending on something that would constitute too much private benefit, something that is has a direct or substantial private benefit to parties that are not intended beneficiaries of the charitable activity. And that if that is direct and substantial in comparison to the charitable activity, then that can defeat the charitable nature of the grant. So you want to make sure that you don't have too much of that private benefit, and of course you don't want any lobbying or political activity in the grant. And so then other things you might look for, and this starts to get into the minutia, so I'll kick it back to you, but acquisition of long-lived assets like a tractor or something that might live for a period of time. If the use of funds was to acquire, property, plant, and equipment or something, that might need to, have a longer reporting period than a cash grant that's spent on services in the same year.
Yeah, and that basically, if in part of that reporting, you should see, is there any of the grant that was being used for obtaining any sort of capital purchases or property, and then that might extend, when you get reporting from that final report. I think it's up to 2 years after you would need additional reporting from if there are any capital purchases. So that's something to consider as well. But the reporting that you get should help you see what was the funds used for. I've seen some that are very vague in terms of like, you gave us $1 million, $500,000's been used, and we are really helping kids read. But I think it should go into a little more detail just to make sure. And this is just part of good grant making. I know there's specific expenditure responsibility requirements to factor in here, but really, I think a lot of grant making, if you want to see that those funds are being used and having an impact, you might want to implement some of these tenets of expenditure responsibility because they're based off of that fact. What do you think, Wendy? Was that a good answer? It's hard to not have that feedback from the question. I could talk about it all
that was
day.
very good. And I realized that I skipped the polling question. So we're going to go back a couple slides just to capture that polling question. So this will be different than our other sessions where it's almost like we're giving you a test to see how well you just listened to Alex and Lauren's response to that question.
Yeah, so the first polling question is, what is considered a full and complete report on how funds were spent for an expenditure responsibility grant to a private operating foundation? And then your options are date and amount of grant, annual report indicating how funds were spent and progress made, may or may not be a full financial report of the type ordinarily required by commercial investors, C, amount expended by grantee, D, compliance with the terms of the grant, or E, all of the above. And then just a reminder, if you would like to receive CPE credit for this particular session, you will need to respond to at least 3 of the 4 polling questions that we pull up throughout this last presentation.
A lot of time the question we also get is, what should the timing of that annual reporting be? Do we have to get that annual reporting before our tax year end? The part of expenditure responsibility to consider is that reporting shows up on that Form 990-PF. So that's the step 3 of expenditure responsibility. After the pre-grant inquiry, you've got those reports that you need to obtain, and then reporting on the 990-PF is just the last portion of it. And that's usually where we come in, unless we're kind of consulting with clients on those grants themselves. But that reporting factors in any of the dates of reporting that you received. The 990-PF factors in the dates of the reports that you've received. So it is good to kind of match that to your year end and to get that annual reporting at that time period. Off the top of my head, I'm not in the regs right now. I don't know the specific requirements this time. Maybe Wendy, you have that one accessible to you, but on an annual basis, I'd say hopefully before your tax year end, you could get that reporting.
Right. Well, it looks like results of the polls, 82%. It indicated all the above, which is a very good answer. Very good answer. And I know option B was a mouthful. So I did want to ask one follow-up question of Ariel. Ariel, I know sitting through the session this morning in terms of outsourcing, in particular grants compliance, I think about the requirements of a private foundation when they do give grants to non-public charities and they do have expenditure responsibility requirements. And we do get a lot of questions from our private foundation clients about, well, we missed this one, or we didn't have all the fields in our software platform. I mean, just maybe quickly thinking about how either outsourcing or internal controls or a software platform could help in this situation. And I know oftentimes with our grant compliance engagements, we've done a lot more recently with federal funding just because of some of the COVID relief, but this is very similar. It's regulatory in terms of the requirements that a private foundation has to. So to me, it seems like there could be some options within platforms that we may be familiar with, where an organization could just make sure they've got the right controls in place or the right platform in place to make sure that they don't miss obtaining the necessary reports and steps that they need to take for expenditure responsibility.
Yeah, it's a really great question. And it all starts kind of with setting yourself up for success at the beginning, right? Making sure that you've got that, like a detailed budget and a detailed kind of reporting platform from those that you are giving the funds to, so that when they do report back to you, you're getting all of the information you need and you've set yourself and those receiving organizations up for success. That can be done, by bringing in a consultant to completely outsource kind of that information gathering review on the front end, making sure that those organizations are tracking appropriately, providing technical assistance around what that means and how it looks so that you do get what you need, or looking at the system that you're using. And are there capabilities within your current system to make this process easier for you? Or is there another system out there? I know in a lot of times this is done via Excel, which just pains a lot of people, right? Human error, lots of manual processes involved with that. And there's a lot of great systems out on the market. So it's definitely worth exploring what can you do on the front end to make sure that you and the organizations receiving funds are successful. And then what can you do internally to set yourself up for success system-wise, currently, and then looking into the future.
Great, thank you. Appreciate that. All right, we've got our next polling question. I'll turn it over to you, Amy.
All right, thank you, Wendy. So the second polling question is, do you have a gift acceptance policy, or do you address gifts of cryptocurrency in that policy? And do you? Your options are yes and yes, no and no, or yes and no. And hopefully that's not too confusing.
That feels like a trick question.
I should have made the polling questions just really simple because it's the last session of the day and no one wants to think that hard by this time. Sorry.
I'm still waiting for the day when what's weird about cryptocurrency is that the blockchain has every transaction that's ever happened with that bit of crypto. So the question is, are you, the ultimate receiver of that crypto, responsible for all of the weird things that have happened to that coin in the past? Like, if I get a $20 bill, I don't know where it's been, and I certainly am not responsible for where it's been. But if I get $20 of crypto, should I have made sure that this little bit of crypto was never involved in a transaction that I wouldn't approve of or want splashed across the front page? I mean, maybe.
Right, especially with ESG policies of organizations, right?
Yeah.
All right, so a little bit surprised. There's a lot of no and no. So no gift acceptance policy and not addressing cryptocurrency in any policy at all. And then there's also a lot of yes and no. So that's good. Do have a gift acceptance policy, but not currently addressing gifts of cryptocurrency. Well, Alex, you just said something very interesting. Any other thoughts just from a legal perspective? And then I'd like to get Liz's perspective from an accounting, and then Lauren, if you have anything to add from a tax perspective as well, in terms of foundations accepting, holding, and transacting even in cryptocurrency.
Yeah, I mean, one big issue that we've seen a lot of is just because there aren't a lot of crypto exchanges, and how do you, the charity, unload your crypto, right? So a lot of charities are, when they get a capital asset like crypto or securities or something, their policy is we get it and we get rid of it. We sell it immediately. As soon as we've gotten it, we try to sell it, which is a fine policy. The problem is that if, from the donor's perspective, if the sell transaction occurs before the gift transaction, then the donor doesn't get the benefit of avoiding the built-in gains and recognizing that built-in capital gain. And so a lot of the ways that these crypto wallets and different types of service providers in the crypto industry work, it's not really clear whether you are selling to a third party or if you're selling back to the provider, the liquidity provider. And if so, did the sale happen before the gift or after? It's very important from a tax perspective and not clear from the marketing materials of the crypto service provider.
Liz, could you speak to the importance of a gift acceptance policy and then just the accounting for crypto?
Yeah, I think it's not surprising that there's kind of a wide range on this of whether or not you have a gift acceptance policy. I think a lot of times if you're a private foundation and you're really only receiving gifts from founders, and you're on the board, you may know what you're going to be giving. But I think, a gift acceptance policy in general is very important because there are so many different types of unique gifts that you can get, and they cause different accounting and control related issues. And so if you haven't thought through it, it's hard at the time you always want to take a gift, but if it's going to cause more problems and cost more money when you have to get the lawyers and the accountants involved, it may not be worth it. And so having set out that at the beginning of these are really the types of gifts that we are willing to accept, and having that documented is important for, I think, just the transitions that may happen at the foundation level. And crypto, specifically, it is an illiquid asset at some points in time. It is volatile. You in that policy, you kind of want to think through, are you going to sell it immediately? Are you going to try to liquidate and turn that into cash? Or, are you in the, I want to hold this and, try to write it out. So there's, thinking about that. Currently, the GAAP accounting is a little unclear on crypto because it wasn't a thing. And so there was no specific GAAP guidance around it. But it was determined that it really isn't a financial asset. It's a tangible asset, and currently is recorded as an intangible asset that you record at cost. So there's a lot of gray area there, and the FASB is currently in the process of writing an accounting standards update to address this, and that current standard, the way it's written now, would put cryptocurrency at fair value. So, it's an interesting, a lot of people want it to be at fair value because typically, that's the goal, is to make money on it and have that asset grow. But what we've seen with crypto over the past few years is it's very volatile. So, if you're holding crypto asset and you you have it at one value. At the end of next year, it might be significantly higher, and then the next year it might be significantly lower. And so there was a lot of volatility in unrealized gains and losses related to those assets. So currently it's held at cost. The value that you receive it at is what you would hold it at until and evaluate that for impairment each reporting period. So and that's hard too, because again, it's very volatile. It could look like there's impairment. You write it down, you can't write that back up until you sell it. So while it goes up and down a lot, you have to determine, is that really an impairment loss, or is it going to come back? And so there's a lot of nuances to the valuation piece of cryptocurrency that you have to take into account. Do you have the team that can really go in and do that, or do you want to even be in this space at all? So it's definitely worth having a policy so you don't have to think about it on the fly.
And then I think Liz keeps hitting on policy, right? And it's not just about the grant acceptance policy or the gift acceptance policy. You're talking about your investment policy. How are you going to handle that cryptocurrency, and if you're going to hold it or not hold it? And then how you're going to record those on your books, both as a fixed asset or intangible asset, and then making sure that you're recording and tracking that. So it kind of flows through your entire internal controls from a financial perspective. So keeping in mind that it's not just, okay, we're going to take this gift or we're not going to take this gift. It's once we've taken this gift, now what? And what's important about that?
That's a good point. The investment policy is really important. And it's a way that your directors and officers can satisfy their fiduciary obligations. The UPMIFA, the Uniform Prudent Management of Institutional Funds Act, says that you shall be prudent, you shall be considered to have acted prudently if you follow modern portfolio theory. And modern portfolio theory says you have to diversify your assets. So how does crypto fit into a diversified portfolio of assets is really the question that you should be asking. And so if you're not holding a lot of, corn futures and gold and other commodities like that, you might not want to be in a big crypto position either. It makes sense to buy a little crypto. In fact, efficient market hypothesis says you should own some amount of crypto in a diversified portfolio because it's an asset. But large concentrations are going to require some other justifications. A diamond hand policy where you never sell, that's going to be a tougher one under UPMIFA.
And from a pure tax perspective, just looking at the tax impact, it really does, the way to talk through tax impact depends on what type of organization you are. So if you're a private foundation, you have some considerations, and the donor has some considerations in terms of that gift and what's the deductibility of that gift and what the threshold is. Crypto is kind of acts like qualified stock, appreciated stock, or depreciated stock, I guess you could say if it's crypto. But it acts like stock, but it's not considered stock. It's considered to be a capital asset. And so when you're looking at the deductibility from a donor perspective, if you're giving to a public charity, a donor advised fund, or a private foundation, there are different rules that would apply to what you can deduct. It was a more kind of prudent conversation back a couple of years ago when crypto was through the roof in terms of its value, looking at, what's the deductibility going to be? What does an organization have to do? The conversation isn't as intense now, that a lot of crypto doesn't have the same value that it did back in the day. Some still does, but if you're giving to a private foundation, if you're receiving as a private foundation, there's limitations to the basis of that property. So if you did get an asset that appreciated in value significantly, you're donating it to a private foundation, your deduction as a donor would only be that basis, the lower of the basis or the fair market value. And as a foundation, if you sold it, you'd have to report any of that appreciation, if there was appreciation, as taxable income. Lower tax rate, but still nonetheless some taxable income for the net investment income tax. But most of the time I'd say now we're seeing a lot of our clients who have that policy aren't really holding crypto long-term, they're usually just turning around and selling it immediately. And so the factors that they'd have to consider are the information return reporting, the 8282s that have to be filed if the assets are over a certain amount, if they're obtaining an 8283 from the donor. So there does, it's kind of similar to if you receive a house. There's like a lot of obligation that goes along with that if you get a house as a donation versus publicly traded stock. And so that's what you'd have to consider if you had that cryptocurrency.
Well, that definitely gives us all a lot to think about, and I hope all the foundations on the line will think about that as well, because there's a lot involved in different facets, and like you said, Liz, a lot of nuances. Nuances is something I gleaned from that as well. Well, thank you for all of that on cryptocurrency. All right, we've got another polling question.
All right, so the third polling question is, do you outsource your human resources function? And your options are yes or no. This should be a pretty quick one. I also want to make you aware that we do have another survey that's set up. This one is different from the one we had earlier since it covers the 2 afternoon sessions. So again, you can find the link in your slide deck and handouts window of your console. And your feedback is always appreciated, so thank you. And this one went pretty quickly, so here's the results.
All right, well, the majority indicated no, which is a great lead in to our next panel discussion. What are some pros and cons of HR outsourcing, Brett? And I don't see you right now, but I think you are on. I saw you just a few minutes ago.
I think I am.
There you are. I can hear you.
Yeah,
I'm sure you'll pop up.
I'm back. Yeah. So, I mean, if you attended the session earlier, I mean, Amy and Ariel and Jen, they outlined a lot of the concepts as it relates to outsourcing and some of the benefits, some things to look out for. I think ultimately, outsourcing is very much a strategic decision within the organization, first of all. A lot of it, is when organizations are growing, a lot of them do what we would call what's called a workforce plan, right? Where I don't know if you guys are familiar with that, but it's really evaluating the overall organization's current and future state capabilities. And a lot of the decision, what you look at that is what we kind of look at as build, which is do we train our employees? Do we hire in new employees? Do we bounce, which means do we let go employees that necessarily aren't meeting certain capabilities? Or do we borrow, which borrow is basically looking at, in many instances, bringing in either contingent labor and or potentially looking at outsource. So it's a very strategic decision in terms of how you actually manage your overall HR organization. So a lot of the pros, I'll start with that. A lot of the pros get to the point where you get some very standardized processes. Your policies and procedures, if along with your processes are well defined, they're adhered to. You also have very defined service level of agreements with a provider, right? So you're basically establishing a contract with an outsourced partner to do very specific things within very specific time frames. It allows you to, really understand what it is that you're getting, but also at the same time being able to hold that outsourced provider at some clear expectations, especially when it comes down to things like compliance reporting, when it comes down to if they're managing your benefits in terms of doing any benefit reporting, payroll reporting, anything like that. So the pros is it really allows a bit of control. I think the other big pro we see with a lot of our clients is that, as I mentioned earlier, whether you're an organization who is fairly static from a growth perspective and may only have, let's even call it a part-time HR person, and that person's also doing the CFO role, right? They may just not have a lot of time to do the transactional based work. And that's a great opportunity to push a lot of that work out. And then the other flip side of that is even if an organization's growing, but they're not planning on investing in a lot of resources within their HR organization, again, this is a great outlet to have a lot of those activities and tasks still delivered, right? So that's kind of the pros of this. The cons of this, and this is where it gets really interesting, because I've walked into some clients where outsourcing has created just a massive disaster in terms of their infrastructure. A lot of times what happens is that we talked a little bit about this earlier, is that we haven't set the right governance and controls with our outsourcing provider, and we actually lose control. So what happens is the outsourced provider almost takes on the ownership of these tasks and duties without getting specific decisions or permissions made about what they need to do. Now, I don't mean just in terms of, managing and distributing payroll or benefits. Really what this gets in terms of, there's certain changes in laws or regulations and things like that they're not coming back and having the conversation with the business about. They're just taking it on their own to administer those things, and it can get the business in a lot of trouble. So really it's the control aspect. A lot of people ask me about cost. In many instances, cost can be a pro. In a lot, depending on what you're outsourcing. Some instances, it doesn't cost more at all, and actually, you're also, the cost that you are paying is helping to manage against risk. So the cost is well worth it. Or do I hire 3 or 4 headcount that I'm bringing internally that now I have to manage the extra costs around benefits and taxes and all of these other things? So it's a bit of a wash. But I think in short, when I would look at kind of the overall picture of an organization, there's not a right or wrong, right? We have a lot of clients doing both. We saw today that the statistics definitely favored much more of an internal HR infrastructure, which, I think I totally support. I think it's great. I think there's a lot of benefits to having internal culture, having the FaceTime, building that level of engagement, all of those things that we're seeing today in the market, that having HR infrastructure definitely supports those things. But there isn't a wrong model, right? And so I think as organizations look to consider this, it ultimately comes down to, do we want to invest in the resources? Where do we want to place our costs? And how do we want to manage our ultimate risks?
That's helpful. And as I think about private foundations, Liz mentioned earlier, family foundations, we were talking about donations at that point, but thinking about a lot of them don't have employees, or they don't have very many employees. So they're definitely lower staffed. And when I think about private foundations, and then there's, the institutional private foundations, if you will. And so, but I will also say human resources is an area where we at Moss Adams, we get a lot of questions. We get a lot of benefits, comp and benefit questions. Lauren can attest to this. We get a lot of information reporting questions. We get a lot of payroll questions. And we get a lot of deferred comp questions. And one common theme that I've heard a lot over the last few years, and heightened with the pandemic, is losing their human resources function, and, or their core human resources staff person. And so I think it's helpful for the attendees to have an understanding of what some of the pros and cons might be, but that also that this is an opportunity for outsourcing if it's needed. Because I do think I do definitely hear of a need often, more often than we used to. Let's put it that way.
Yeah. Yeah, or I would say when even the partial outsourcing, right? And that's where I typically see, if you talk about some of the big pros, it's outsourcing those specific tasks that you either don't have the capabilities to do internally or you don't want to do, right? Frankly. So it's not necessarily a full outsource. It's more of a hybrid model, but you're still able to maintain and keep all the controls internally, and really looking at an outsourcing provider is, and I hate to use this term, but really a taskmaster. They are executing the tasks that you're asking them to execute.
Great. All right, we've got our next polling question. Turn it over to Amy.
All right, this is the last polling question of the day. How might a private foundation take on the additional steps needed for expenditure responsibility if limited on resources? And then your options are A, grants compliance outsourcing, B, internal controls, C, policies and procedures development, or D, all of the above. I thought you were doing background music there. I heard it chimed.
You did mention earlier that we needed Jeopardy music for these.
Yes.
Right.
All right, here are the results.
Great, an astounding 80% all of the above, which I think Ariel would agree with. Ariel, I had a planned question for you, but I think we've beaten that horse in terms of grants compliance and internal controls policies and procedures. But we did get a couple of questions earlier during your and the other consultants' sessions that I thought I would ask in place. So one of the questions was, my organization is small and doesn't have any policies. Is that a requirement of all funding? And this might be a joint response from our panelists here, but I'll let you take that first, Ariel.
Yeah. Excuse me. So I wouldn't say it's a requirement necessarily of all funding sources, but it is definitely something an organization needs, right? You need to have a solid defined practice or policies of, this is how our organization is going to be run. These are the standards we're going to meet, and this is how we're going to get there. And that's where the procedural side of things comes in, right? Making sure you have the appropriate segregation of duties, that you have the appropriate internal controls and systems in place to make sure that you are tracking and monitoring all of the funding sources that you have, whether that's revenue generating or not revenue generating. And this is regardless of organization type. So while if you're looking at funding sources that are non-governmental, it may not necessarily be a requirement. And when you're looking at those government funding sources and specifically federal funds, it's definitely going to be something that is looked at and questioned. But it really just depends. And it depends on your organization size and how in-depth these policies and procedures need to go or how broad they might be. I don't know if others here have perspective on that. From a foundation perspective.
I would agree with you that so it's a little tricky because if you have a policy that you don't comply with, that can increase your legal risk because not following your internal policies means that the fiduciaries are in breach of their duty of care, and that's bad. That means that it's harder for them to invoke the business judgment rule to protect themselves in the event of a loss or a harm resulting from a decision that they made. So you don't want to do that. You don't want to have a policy and not follow it. But I definitely agree that you want to have policies because you want to make decisions in a consistent manner. And your policies inform the procedures that you follow to make your decisions and the consistency of those procedures. So I think that's a way of demonstrating duty of care to actually create these policies and have them addressing common circumstances. Now, you don't need a policy if you don't need a crypto acceptance policy if you're never going to accept crypto. That's a waste of time. But even the IRS has said even the smallest organization needs to have a conflicts of interest policy, a document retention policy, and a whistleblower policy. Some might disagree with that or put some different policies in there, an investment policy or some sort of audit, your audit policy. But generally speaking, those are the core ones.
And I think when you're thinking from a broader lens, also having that financial management and reporting, so making sure that you have that internal accounting tracking mechanism and how you're going to report out on that is extremely important. And so, like Alexander said, if you have a policy and you're not following it, that's going to get you into some trouble down the road. And that's where that update process comes in, right? Maybe you do have something documented, but you're not sure if it's right, if it's accurate, if it's current. That's where taking some time to really take a step back and say, okay, when was the last time we looked at this, and how applicable is it to today and where we're going in the future, and how can we make updates to make sure that we're, compliant and that we're setting ourselves up for success.
That's great. Thank you. I want to, if we could, tackle a few more questions that were submitted earlier today, and then we'll come back to alternative investments if we have time, which I think we probably will. Alexander, you weren't part of the first session this morning, but we had a session on taxable expenditures, but I know that you are very knowledgeable in that area, and Lauren, you may have some context to add as well, but we do have a few questions that were asked during that session that I thought that we could tackle here as part of this session. So one of them is, if a foundation manager accidentally charges through a personal expense on a corporate card, a foundation owned card, is this a taxable expenditure? And the second part of that is, would it matter how quickly the manager repays the foundation once they discovered they charged a personal expense on that corporate card?
Yes, so it's actually, there's a, the rule for that sort of accidental payment of a personal expense is often covered under the automatic excess benefit transaction rules, which say that if you are receiving a payment of a personal expense that isn't part of your compensation, that there could be an automatic excess benefit transaction under 4958. For private foundations, under self-dealing under 4941, the rules are slightly different. They're more prescriptive about the type of payment. So I want to first flag that you could have a self-dealing transaction or an excess benefit transaction. But the oopsie, is actually part of the accountable plan rules, and there's, the general rule is that if you rescind a transaction within the same tax year, it's kind of like taking a mulligan, and it can be corrected as long as it hasn't gone over over a tax year. Things can be undone, but others may have more color to add to that.
No, I think that's a good point, and it does depend on whether you've got a foundation or another 501c organization as to which rules would apply. So I agree with that there, but I think it kind of depends too. So yeah, you look at your accountable plan rules and you look at the frequency and the intent, and if it was an accidental switch or something, or if it was intentional that was then caught and reprimanded, and if there was some way to see that could influence the next steps that you take. But it is a challenge to report those. And when you have if you're filing a Form 990 and you've got a Schedule L and you have to report an excess benefit transaction that was discovered, it's a real big red flag, even if it is corrected. So it's something that you'd want to consult internally, look at your policies and procedures, document the findings, document what happened before you report it to the IRS there or on the 990PF if it's maybe potential self-dealing.
Yeah, and the taxable expenditure area. So a grant to an individual, if it's not a qualified scholarship or appropriate grant to an individual, would be it could be a taxable expenditure. But the payment of overhead and salary is not a taxable expenditure. So if we're talking about mistakes in the payment reimbursement of expenses that are work related or personal, that's probably going to go into the administrative overhead category and not be a taxable expenditure.
What if it was a reimbursement for a political activity and they accidentally put their support for a candidate on the credit card, the company credit card.
Yeah, and it doesn't get corrected. Yeah, that I mean, can you make a taxable expenditure if you don't? Right, good control. Make sure you have good controls. If you didn't know that that the payment was made, did you make a taxable expenditure? I mean, there's
yeah.
And I think that goes back to.
Oh, go ahead.
Go ahead, Lauren.
No, I was just going to say that.
I think that goes back to the conversation that was being had on this morning's panel related to doing those reconciliations and finding those variances and following up on them and doing that timely, and building that into your policies and your internal controls to say, if it is identified and it was accidental, we all know that happens. Here's our process in the turnaround of we're either going to, you're opting for us to deduct this out of your paycheck, or you're going to pay us back out of pocket. And here's how long we expect for that to take so that it doesn't bounce into that next tax year. Now, if you fall into that, it was an intentional thing. You're talking about a fraud, waste, and abuse policy and the way that you handle those types of issues as they arise, which is just different.
I do want to also add something else to that you made me think of in that comment is we do tax risk assessments with our audits. So we go through and assess any, potential areas of tax risks. And one of the questions that we ask a lot is who reviews and evaluates the CEO's expense reimbursements? And a lot of times that falls on potentially the CFO or someone else in the organization. And one of the things we like to highlight in those conversations is that, those expenses of the CEO, the CFO, they should be reviewed by, the CEO, especially maybe by the board chair or somebody who is supervisory to that CEO, because there might be more questions and follow-ups on expenses like that. So inadvertent expense reimbursements, if you have a subordinate reviewing it, they might not bring things up or question that. So making sure that you've got great procedures in place is also helpful to curb that before it gets to be the year end and something happens at that point that makes it a potential excess benefit transaction.
Great. Well, this is similar in theme, and you alluded to political expenses just a minute ago, Lauren, in an example, but there was an additional question in regards to lobbying and political. Can this be as simple as on the social media platform liking or following a political candidate?
That's okay. I would say that you can, okay. Liking and following a political candidate, I would say that's okay, because if you're following, all you're doing is you're saying, I want to hear more about that person. Like my own personal Twitter, I follow all the weirdos because I want to hear what they have to say, far left, far right, whatever. And I certainly don't endorse anything any of them have to say. But I guess liking, I don't know what liking really means. It's not necessarily a statement that you endorse what they're saying in that tweet. I think it's more of a, acknowledge that that's a, you said something, or maybe that was funny. I would maybe steer clear of liking candidates' statements, but Twitter can be very dangerous because you can very quickly get into lobbying and political activity by making a statement of support or opposition to a specific legislative proposal. You can't do that with foundation resources, and you certainly can't get involved in political campaign activity.
And whether you can do it, I don't know if you should do it. Just because you can like or follow someone, I mean, it's great for our news sources as well, but you risk alienating somebody else, and you don't know who might flag you to the IRS or send in a complaint. There is a way that you can send in whistleblower complaints to the IRS, and we've had a lot of organizations that fall one way or another that have suspected a political enemy or adversary has flagged them for audit or something. So that might be something to consider as well.
And just a clarifying question, Alex, in terms of not liking but following any additional comment on whether that's the foundation's Twitter account, for example, that follows versus a board member or an employee?
Right. Yeah, I think that it's always helpful when you're doing social media and you're an employee for an organization to have some kind of statement that you're doing so in your individual capacity. It's hard on a tweet by tweet basis to do that, but you might find you can encourage employees to put in their bio that they're speaking on their own behalf and not on behalf of any organization they may be affiliated with. I mean, board members could be board members from many organizations, and they should disavow speaking on behalf of any of them on social media. I guess I would ask the question: what purpose does having your foundation follow somebody achieve? Because the foundation isn't necessarily going to read what the person that they're following posts. So I don't, maybe you don't need to follow other people as the foundation's official Twitter account.
That makes sense. Yes.
Yeah.
And then we had one more question. Again, this is in the taxable expenditure area, and I think this will be I know this is a simple one, and it may have been addressed in the session, but it's when is a grant expense to a nonprofit a taxable expense? And for instance, and this is part of the question, if a financial report by a grantee is not submitted, does that cause it to be a taxable expense?
I think so. Taxable expenditure rather than a tax. I think
yes,
the
taxable
tax lawyers,
expenditure. Yes.
The tax folks are probably all thinking, are we saying is it a business expense or a personal expense versus a taxable expenditure? So taxable expenditure, if they fail to do so, say you've made an expenditure responsibility grant and the grantee fails to provide the reporting, does that now convert it into a taxable expenditure? I think they think the answer is yes, although you have some reasonable cause efforts to try to get the grantee to comply. Of course, it's not totally within the foundation's power to get the grant, but you have to expend all reasonable efforts to compel the grantee to give the reporting, maybe call the money if you can.
And I think in terms of grant expenses to a nonprofit, that would be a taxable expenditure. I mean, we went through those in our session this morning, but think of non-public charities. This is for the audience, but non-public charities, your C4s, C6s, any for-profits, same thing with program-related investments to for-profit organizations. Just wanted to clarify that so that whoever asked that question, make sure they have that general context as well.
Yeah, so it's if any economic distribution, whether it be in kind or in cash, can be captured by the taxable expenditure rules. So if you're, providing some kind of expense to the grantee beyond the grant, that additional expense may well be covered by the expenditure responsibility rules as well.
Okay. I did have one question that I wanted to ask you, Alex, if you're willing to be spontaneous and take it. A couple of us attended a conference last week that was specific to private foundations. A few of us also earlier in the week were at a conference regarding community foundations. And at both conferences, there was a legislative update, and the topic of the recent lawsuit against Harvard and UNC came up, and how that can pertain to private foundations or community foundations in each case, to their grant making. And I thought this was a really interesting discussion. I can tell you in both conferences that I was at, that's where the most questions came, is after those sessions, because I don't think anybody had thought about it in that context. And just to give the audience a little quick background before I let Alex speak, because I know he's going to have something just very interesting to say about this, because the attorneys at these other conferences did as well. But this is the affirmative action lawsuit that basically says that race cannot be part of a college admission process in order to achieve a diverse student body. So think about your grant making as a private foundation and any grant making programs that are very targeted to a specific race. And with that, I'll let you answer, Alex.
Okay, great. So yeah, there's a lot to say about this, and there will be a lot more to say because it's kind of unspooling even as we speak. So the case itself talks about the use of race as a determining factor in the admissions process to Harvard and UNC. So first of all, the case applies to all admissions processes for all universities, private, public, et cetera. So that's one important thing. But how narrowly or broadly to read the case, there are. I'll tell you how to read it narrowly. For one thing, if you're talking about a school, and I recognize you asked about foundations, but I'll get there. If you're talking about a school, you've got 3 steps in an admissions process. You've got getting people to apply, the recruitment. You can use race in that. The case does not apply to that. You've got admissions. The case does apply to that. You can't use race as a determining factor without considering it in the context of other factors as a kind of a personal statement that might take race into account, as well as economic factors, socioeconomic upbringing, et cetera. And then there's the third step of the process is after people have been admitted, are they going to come or not? Are they going to actually matriculate at your school? You can use race in the third step to encourage those who have been admitted to actually matriculate. So that's the first thing about the scope of the decision in the school context. Now, turning over to scholarships, which is really the area where foundations are most affected. A lot of foundations have scholarships that might use race as a factor. Here's the analysis that says the decision does not apply. Okay, a scholarship is a payment to the recipient for their benefit. It is not a payment for services or any kind of return benefit to the foundation that is making the payment. In fact, it is a payment proceeding from detached and disinterested generosity. It is a gift. It is a gift, and gifts are not covered by the case, and they're not covered by other areas of the law, particularly Section 1981. If it's not a contract, Section 1981 does not apply. It's not federal funds under Title VI. It's not employment under Title VII. It's a gift. None of that applies. So there's your answer. It doesn't apply. However, as this whole thing is unspooling, there are these general principles that the Supreme Court has kind of unleashed, which say things like, it inherently violates the 14th Amendment to use race because using race to benefit one applicant automatically is to the detriment of another applicant. You can't use race without harming somebody based on race. Therefore, all uses of race are unconstitutional. That would be dicta. It's not legally binding, but it is an idea enunciated in that case. At the same time, that case also enunciated the idea that use of race is totally fine as long as you don't use it as a stereotyping mechanism and instead consider it as one factor among multiple factors. So if your scholarships require a personal statement or essay or something like that, you're probably going to be fine, even if this unspools in a way and the decision applies more broadly than in college admissions.
Well, great. Thank you very much for tackling that question, especially since I put you on the spot.
Sure.
With that, we are at time for today. I will turn it over to Amy, and thank you all for attending, and to our panelists especially.
Yes, thank you, Wendy, and thank you, Brett, Liz, Lauren, Ariel, and our special guest presenter, Alexander Reid, partner from BakerHostetler. It was a really great discussion today, and this is the end of our sessions for today. I hope you all enjoyed the first day of our virtual private foundation conference, and we look forward to seeing you tomorrow for day 2. We have several great topics lined up, so please check your agenda to see what's to come. And we hope you'll be able to join us tomorrow, and take care, everyone.
Thanks. Bye-bye.